Hey everyone, and welcome back to another video for today. So quick update on one of our favorite companies we cover on the channel, one of my favorite holdings as well, and that's SoFi. So SoFi on Friday was down almost 8%. After hours, it actually went up 1.1%. But on Friday, SoFi stock, a fintech company in the United States, got hit by 8% because of the whole tariff trade war going on again between the United States and China. And now to lighten up the mood, we do have here the tweet of the week from Vadim, a very, very good follow if you are interested in SoFi. I hope SoFi will still have access to the rare metals that they need for the loan platform business. Good one. And of course, this is not the first time that we see stocks that are not really related to this whole trade war story that they get hit. Now, yes, you could say that indirectly everything's connected, right? Yes, okay, if the economy will not do well because of this trade war, then people might have to close their shop because, well, the tariffs are too high. They cannot sell things that they previously sold because it came from China. And now the import tax is super high, so they're not making profits. They have a loan, they cannot pay a loan. Okay, I understand it. But right now, that's a bit far-fetched, I would say. Plus, it's down 8%. We've seen other companies that were down way less than 8%, and yet they have, I would say, greater exposure to this whole trade war, well, whatever you want to call it. So, overreaction? Yes. Now, let's talk about some positive things with regards to SoFi. We're going to do that throughout the video, so hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. First up, SoFi is still a $33 billion company right now. SoFi is, yes, eligible to enter the S&P 500. I don't know when that will happen, but I know that it will happen eventually. It's not something that I will keep myself awake at night and, oh, maybe tomorrow we will get in. No, I don't care because I know that eventually we will get in. Now, on the positive news side of things, we've had a couple of product announcements from SoFi. Now, not major announcements, although some might say that yes, options, level 1 options, that's a major announcement. Crypto coming back, that will be a major announcement as well. But we've had this, for example, coming soon, move money between SoFi accounts instantly. So instant transfer between SoFi Money, SoFi Invest. They're rolling out level 1 options trading, and they've expanded their exclusive IPO access. Now, why is this a big deal or just a deal? Well, simply put, we have to go back to, of course, the reason why we have Technisys and why we have Galileo. So the core idea is that SoFi is moving off third-party tech onto its own unified system, which should fully be done by the end of this year, right? It's quite crazy that it took so long, but okay. Then, the company publicly stated that the overall shift to the unified core for certain commercial services was targeted for completion around November 2024. More importantly, the acquisition was estimated to generate between $75 to $85 million in cumulative cost savings from 2023 to 2025 and a massive $500 to $800 million in cumulative incremental revenue through year-end 2025 from synergies. Right? This is what was mentioned in the past. Now, once you have that integrated stack, of course, this allows them to build and launch new products exponentially faster and cheaper than rivals who rely on external vendors. That was the whole theory behind, right, being that one-stop shop built on your own tech stack. And so that will happen pretty soon, which is good because as users of SoFi, you would like to have everything you need on that one app. If you want to trade, if you want to save, if you want to loan, if you want to do whatever you want it to be available in the SoFi app. And of course, with the best UI, UX possible. This is something that Robinhood has been doing extremely well for years and years, right? The usability, the ease of use of Robinhood is unmatched for now. And again, the question, why is that important? Well, if we go and look here at Emir or Type F Capital, you've seen this already during the live stream, we know from management that one, SoFi Invest is 50% under monetized, and they believe this offering can eventually be as large as SoFi Money. SoFi Money is this right here. Then you've got Relay, which is a big chunk, but is not really, well, it's not generating anything, to be honest. And then you have SoFi Invest. Now, if SoFi Invest suddenly starts to accelerate, well, you've got one hell of a business that will accelerate from here as well. Plus, brokerage fees are just 5% of its non-interest income. So, for those that still think that we only have the loan platform business as tailwinds, think again. Moving on, we've got analysts that have upped their estimate with regards to EPS. One of them is Devin Ryan from Citizens GMP. Here on TipRanks, although I will say time and time again, TipRanks scores are not that accurate. But okay, doesn't matter. His profile here is quite good. These are some of the names that he covers. Average return has been very, very good. So, what did he say? Well, I don't have the full report, so this is basically the headline. Citizens GMP, or him, hiked their Q3 EPS target from 7 cents to a consensus beating 12 cents and 38 cents for the year and 60 cents for 2026. Remember these numbers. They modeled previously for a decline in the loan platform business, but now they see a sequential increase of 17%. So you go for their Q3 estimate. So you go from, oh, we're thinking that the loan platform business might experience a decline in Q3, and now we go to a sequential increase of 17%. Not too shabby. Bank of America also raised their target from 8 cents to 10 cents. Although their price target, or they still have, I think, an underperform rating, their reasoning behind it is because, well, the stock is priced to perfection. The stock has gone up too quickly. Now, if we go and look at SoFi's own guidance for this fiscal year 25, which of course has been revised on the upside, and as you know me, I think the upcoming earnings report is going to be a triple beat. Double beat for the quarter, and then guidance will be raised again. Why do I think that? As I explained in another video, adjusted net revenue is expected to grow 30% for the year. Okay, previously that was between 24 and 27%. Now, it doesn't make much sense to me because Q1 and Q2, these were the numbers, which means they expect Q3 to be around 874 and Q4 to be around 874. Of course, Q3 can be a little bit lower, and so Q4 will be a little bit higher. But does that mean that you will barely see any growth between Q2 and Q3? Does that mean that you will see any growth between Q3 and Q4? It doesn't make any sense. And so, again, I think revenue-wise, we are going to go much higher to end the year. Then, if you look at diluted earnings per share here, 31 cents is the company's guidance, right? Currently, what we've had is 6 cents, 8 cents. Then for Q3, the current estimates are 8 cents as well and 9 for Q4, which means you basically reach the 31 cents right here. Now, if we add 4 extra cents from the analyst, you will get 35 cents, which also means that he believes that in Q4, you will be able to add another 3 cents to these estimates. So he believes that in Q3 it's 12 cents, and in Q4 it's probably also going to be 12 cents to reach his target of 38 cents for the year. Then for next year, it's 60 cents, which of course, again, is a huge increase in EPS. That's why where people look at, oh, look at the PE, it's super high for SoFi, it's a bank. Again, banks don't grow EPS this quickly year on year. But that's not all. Remember the 2026 targets from management. GAAP EPS between 55 to 80 cents for the full fiscal year 2026. That's midpoint 67 cents. So still higher than the other analysts. Almost a 2x increase from the 2025 estimates. In my opinion, again, easy targets to beat. And management has been very pessimistic when it comes to their own macro assumptions. Right? It's not new. It's been like this for over a year now. The long-term EPS growth rates, not me saying, SoFi's management, sustained compound annual EPS growth rate of 20 to 25%. So, you tell me, are we that expensive? Or is Wall Street just, again, not understanding the story? Or maybe they still do not trust the company and management, despite management beating their own expectations and Wall Street's expectations time and time again. If we go back and look at what Wall Street is expecting SoFi to report revenue-wise for this fiscal year and the upcoming fiscal years, we can see that the lowest point for this fiscal year is $3.3 billion, the highest $3.5 billion. The next year, 4.6, 3.9 is the lowest billion dollars. Fiscal 27, $5.7 billion, $4.4 billion as the lowest point. We're going to look at EPS for the same fiscal years. Same thing here. Of course, we've seen now the highest point is 35 cents, has to be updated because we just got 38 cents. The lowest point, for some reason, is still 3 cents. Then, for fiscal 2026, we have here 70 cents as the highest point, 42 cents as the lowest. Fiscal 27, we're already here at $1, and the lowest point is 56 cents. So, technically speaking, what you're paying now is, 26.4 times 2027 earnings. 26.4 times 2027 earnings based on, what we now know are usually very low estimates. But okay, fine, even if they are low, let's take them. 26.4 times earnings, fiscal 27 earnings, for a company that's expected to grow 20 to 25% compounded for a long period of time. Is it that expensive? Probably not. Probably not. And so right now, if we look at the stock, it seems like, depending on what happens next week, maybe we might see that retest of the 50-day moving average yet again. Previously, stock went down 17% or so. We touched it, and then we rebounded. We were really on a recovery here until, of course, the trade war tariff story started again on Friday. But all in all, for SoFi, the story is still the same. It's a tremendous company, tremendous management, quite a long growth road ahead, right? Because I don't even think that a lot of people are currently calculating the impact of the crypto business, right? Because we don't know. We don't know how big of a user base for crypto there is on SoFi, so it remains to be seen. We don't know if SoFi will acquire any other companies out there. TBD. So there are still quite a lot of growth levers left for the company to pull, and in my opinion, plenty of tailwinds. Yes, if the economy does take a downturn, it will be bad for everyone. But as we've seen with SoFi over the last couple of years, even when interest rates are extremely high, even when lending was basically dead or supposed to kill the company, they actually survived and came out of it a much stronger company. So doubt them at your own risk, I would say. I'm still extremely bullish on SoFi. It's a very big position for me. And to be honest, I wouldn't even mind adding more shares. So that's about it for me in this video. If you enjoy this type of videos, hit all the buttons. We'll see each other in the next one. Bye-bye.